I've seen this before in the 70s, 80s, 2000, 2008. Always the same pattern. The market starts showing clear signs of strain, but nobody wants to listen because as long as the indexes rise, euphoria feels more comfortable than the truth. But this time it's different. The collapse isn't coming. It has already begun. And the most dangerous part is that it's happening in complete silence, without headlines, without panic, without warning. We're living in a moment where the appearance of stability hides unprecedented structural fragility. Rising debts, artificial consumption, bankrupt companies disguised as innovation, investors betting on thin air, central banks losing control, and yet optimism continues to be sold as wisdom. It's like driving 120 miles per hour blindfolded, simply because we haven't crashed yet. But those who look at the fundamentals see something else. They see a system operating at the limit. They see trust slowly evaporating. They see bubbles inflating where there should be value. They see the same collective behavior that preceded every major crash in history, only this time with much more speed and much less braking. This video isn't about panic. It's about clarity, about seeing what most people don't want to see. Because the market doesn't warn you before it turns. It just turns. What intrigues me the most isn't the speed at which assets appreciate, but the complete indifference to the logic behind those prices. We are facing a bubble that makes no noise, doesn't explode all at once, and that's exactly why it's even more lethal. Inflated valuations, fragile business models. Investors believe in the recent past is a reliable guide for future, but it isn't. There are no fundamentals, there's faith, and faith is not a good investment strategy. People are buying companies with no profits, often without a validated product, only promises. That's gambling, not investing. The difference between investing and gambling is clear. Investing requires patience, discipline, and rationality. Gambling relies on luck and hope. Understanding this is what separates those who survive crises from those who get lost in them. Things the market has been ignoring. The bubble is forming precisely because the market is being driven by behavior, not results. And when this happens, the house of cards grows quickly, silently. The liquidity created in recent years, combined with speculative mindset, has inflated entire sectors without real support. It's as if we're building a skyscraper on quicksand. It won't fall today, but it will fall. And here comes the most dangerous part. When everything seems too stable, that's when collapse begins. Not like an earthquake, but like a slow leak in the foundation. Gradually invisible, but real. And this is just the first sign. The truth few want to face is that most of the recent market growth was bought with cheap money. And when money is cheap, recklessness becomes fashionable. The artificially low interest rates created an environment where any idea seemed profitable, any investment seemed safe, any risk seemed controlled. But it was all an illusion. Growth was inflated, not organic. For over a decade, we've lived in an era of easy capital. Companies that would never have had access to credit or significant funding suddenly raised billions based on fantastical projections. And this contaminated the entire ecosystem. When everything grows at the same time, no one wants to be the first to stop and do the math. The party continues because everyone pretends the ground is solid. The problem is the bill arrives, and rising interest rates are the waiter bringing the check. When the cost of capital rises, the filter starts working again. Unviable projects begin to fail. Accumulated debts, once manageable, now become unpayable. Investors begin to realize they may have been looking in the wrong direction all along. Many companies only seemed sustainable because they were swimming in free money. Now, with monetary tightening, that facade begins to melt. The growth that seemed organic is showing its cracks. Quarterly reports that once seemed impressive are beginning to show warning signs. The market has not yet absorbed the full impact of this cycle shift. It is anesthetized by the recent past. But the era of illusions is ending, and the next symptom will appear in a place no one wants to face. The greatest risk to the American economy today isn't an external crisis, a war, or a pandemic. It is the internal deficit itself. The government keeps spending far more than it collects year after year, as if this were sustainable forever. But it isn't. And the market acts as if this billion-dollar hole were just an abstract number, without real consequences. Yet every debt has a creditor, and eventually the creditor demands payment. When the world's most powerful country starts funding its operations by printing money and selling bonds as if they were candy, the system goes into emergency mode silently. Because these moves don't trigger immediate panic, they erode from within. The dollar weakens. Interest rates need to rise. Confidence starts leaking at the edges. But no one cares as long as the S&P 500 keeps climbing. I've seen similar cycles, but never with this level of collective myopia. The obsession with the short term has made Wall Street ignore the basics. The cost of carrying debt rises, budgets break, and we are ever closer to this invisible limit. Instead of cutting spending, politicians prefer to push the problem forward. 1 year, 2 years, another election cycle, and the market pretends to believe. The fragility lies precisely in this illusory confidence, because it only takes an external event, a political crisis, an inflationary surprise, any spark, to ignite this bomb. And there's no way to predict when. All we know is that it's armed with a lit fuse, while everyone pretends it's just another relevant accounting figure. The market acts as if this risk were invisible, but I've learned that the greatest dangers are always the ones nobody is watching. And when this tide turns, it will sweep along another fundamental piece of the system. The American economy has always run on consumption. The average citizen buys, finances, and spends money they don't yet have, and this keeps the entire engine running. But there's a problem. This model works as long as consumers remain confident and have easy access to credit. Today we face a scenario where optimism has dropped and personal debt has skyrocketed. This is a sign of weakness in the main engine of the system. Household debt has reached levels reminiscent of 2008, but with a brutal difference. Interest rates are now much higher. This means payments weigh heavier, delinquencies rise, and consumption starts to falter. Yet this isn't visible in the major indexes. It's in the details. Fewer retail purchases, rising personal bankruptcy filings, declining mortgage renewals. While the markets celebrate big tech profits, the base of the economy, the average consumer, is suffocating. Inflation has eaten purchasing power, wages haven't kept up, and credit cards have become an emergency solution for basic needs. This isn't growth. It's survival disguised as stability. And when this behavior spreads, the risk becomes systemic, because consumption represents more than 2/3 of the U.S. GDP. One of the most ignored symptoms of the current economic fragility is the so-called zombie companies. These are firms that survive only by continuously taking on debt. They don't generate enough profit to cover operational costs, let alone pay interest on their debts. They're alive on paper, but dead in practice. And the most frightening part, they exist in every sector, across all stock exchanges, infiltrating portfolios of many unsuspecting investors. These companies were sustained for years by low interest rates and abundant credit. In an environment where capital was cheap, any business could stay afloat, even without efficiency. But now the game has changed. With high interest rates and more selective investors, the money has disappeared. What remains is a fragile structure, with negative cash flow, burning cash to pretend growth is happening. It's easy to spot a zombie, always raising funds, constantly in growth mode, but never showing real profit. It promises the future, but fails to deliver the present. Yet many are still being bought by uninformed investors, deceived by narratives of innovation, disruption, or opportunity-driven valuation. I've seen this movie before, and I know how it ends. The risk isn't just in the bankruptcy of these companies. It's in the chain of destruction they create. They hire poorly, burn resources, distort the sectors they operate in, and feed speculative bubbles. When they fail, they drag down suppliers, investment funds, banks, and even more solid competitors who rely on the same market. The presence of these companies is a clear sign that the economy isn't healthy. It's a metastasis. And while the indexes keep hitting records, there's necrosis happening inside the system silently. The next layer affected is the one that seems immune. But it isn't. Something has changed profoundly in recent years. Speculation has stopped being an exception and has become the norm. It's no longer a bubble or a fleeting moment of euphoria. It's a culture, a way of thinking, investing, and handling money. And this, to me, is the most dangerous signal of all. Because when risk becomes standard, rationality dies, and the market starts functioning like a casino disguised as meritocracy. Just look at investor behavior. People buying stocks based on viral videos, crowds entering IPOs like a lottery game, leveraged traders in assets they don't even understand, thinking volatility equals opportunity. Platforms reinforce this logic with colorful charts and instant rewards. This isn't investing, it's addiction. I've always believed that investing should be like watching paint dry. Slow, methodical, boring, yet more efficient. But the new generation craves excitement. They want double-digit gains weekly to double their wealth in a month. For that, they ignore fundamentals, ignore risks, ignore history, and sooner or later, they'll learn the hard way. The market is ruthless to those who don't respect its cycles. And when speculative behavior spreads too far, it becomes a trigger for crisis itself. Because everyone rushes to the exit at the same time, and there's no way out. Panic is always a consequence of poorly managed euphoria, and euphoria is everywhere. This gambling culture has been feeding inflated assets, fragile companies, and baseless promises, eroding the logic of value. When the foundation is weak, any shock topples the entire building. The next market move already shows where the structure is failing. The biggest mistake I see repeating and still costing fortunes is confusing movement with direction. Many believe that just because the market is rising, everything is fine, that they can simply jump in and ride the wave. But the market doesn't reward haste or blind faith. It rewards consistency, patience, and discipline. This applies both to beginners and to those who should know better. Beginners are usually victims of haste. They think they can shortcut the path by watching their neighbor, an influencer, or the next trendy stock. They buy without understanding, sell based on a headline, and jump from asset to asset like it's a video game. But veterans also make mistakes, often with greater severity, because they trust too much. They think they've seen it all, that they can recognize the signals. They become blind to present, blinded by past victories, ignoring that markets change, conditions change, and risks change. And when ego grows bigger than humility, the fall tends to be greater. I've seen this happen more than once, even with big names. The common point between both profiles is the belief they can control what they don't understand. Whether through impulsiveness or overconfidence, both expose themselves more than they should. And this is dangerous, especially now, in a scenario where variables are more unstable than they appear. Good investing requires embracing boredom, knowing when to say no when everything screams yes. This goes against human nature, which is why so many fail, and why so few can foresee the next mistake before it happens. The market loves to confuse price with value, especially in down times. When assets fall, the average investor rushes to buy bargains, as if being cheaper automatically makes something more valuable. But price is what you pay, value is what you get. This simple distinction is ignored by almost everyone during critical moments. I've seen stocks plummet 70% and still be overpriced because they lack fundamentals, generate no profit, and have no competitive advantage. And I've seen others fall 10% and become extraordinary bargains. Value isn't in the chart. It's in fundamentals, the business model, management quality, and predictability of results. But no one wants to look there. It takes effort. And today, the market is lazy. Falling prices create the illusion of opportunity. But true opportunity only exists when an asset is discounted relative to its intrinsic value, not just compared to what it cost yesterday. This requires calculation, conviction, and resisting the noise, the headlines, the anxiety. Buying value is an act of solitary courage because you're almost always alone when you do it. The great opportunities I've seized in life came when everyone else was running in the opposite direction and almost always involved assets being unfairly punished by the market. But this was only visible because I knew exactly what I was buying. And that clarity doesn't come from guesswork. It comes from study. Right now, many cheap assets are being sold as treasures, and treasures are being ignored because they've fallen out of fashion. Separating one from the other is what determines who survives and who sinks in the next phase of the collapse. It's not in promising tech, disruptive startups, or speculative bets. My money today is in simple, predictable businesses that generate profit even under pressure. Companies with real products, established brands, conservative management, and robust cash flow. I like what I can understand in 5 minutes, and that will still exist 20 years from now, even if the market turns upside down. While the world chases trends, I stay focused on fundamentals. Energy companies, insurance, infrastructure, food, essential services. Businesses that sell regardless of the economy's mood, maintain margins even in adverse cycles, and pay dividends without compromising growth. This predictability is worth gold today. And what do I avoid at all costs? Models that rely on constant capital. Companies that have never been profitable. Leverage businesses. Futuristic promises that can't survive 3 bad quarters. I also avoid fads. Crypto assets nobody understands. Fintechs with uncontrolled burn rates, and sectors that live more on narrative than results. I'm more liquid than I'd like, but I'd rather miss an opportunity than take on a risk I don't control. Having cash is having freedom. And freedom, in times of uncertainty, is the greatest asset there is, because it allows you to act when everyone else is paralyzed. And acting with conviction is what separates the ordinary investor from the anti-fragile investor. The next bullish cycle will start in silence, in the right assets, away from the spotlight. And when it happens, I want to be positioned with patience, not desperation, because the real game is decided in waiting, not in rushing. Anyone who's listened this far already knows. Collapse doesn't start with screams. It starts with silence. And those who don't understand this repeat the cycle. Always remember and share this phrase. Price is what you pay. Value is what you get. Because in the end, that's what separates those who sink from those who navigate the storm with clarity. If you truly want to change your relationship with money and learn to invest with clarity, patience, and conviction, like this video, subscribe to the channel, and share with anyone who needs to see beyond the headlines. Knowledge is the greatest weapon against cycles of illusion, and only those who prepare survive the next market moves.